One of the best technical indicators to use when trying to smooth out an overall chart or trying to see a specific trend is using a moving average. Now, in this video, we're just going to cover a couple different moving averages, but more or less, what a simple moving average is that you take a period of time. So it can either be one day all the way up to however many months you want. And then you are going to take all the price closes from that period of time, add them all together, and then divide them by that time period. So in this instance, we have the 200 SMA right here. This is that pink line here that we're looking at. So what this is doing is it's taking from this day's close and it's going back 200 days. It's adding all of those closes up together, and then it is dividing it by that 200-day period, and that is how you're getting your average day. So what that does, it actually smooths out the trend for you. So you'll notice that on the more recent date or the shorter time period moving averages, that you're going to get a lot of whipsaws, right? So we have this 9-day EMA here that we're looking at, and you can see how much it kind of moves up and down, right, compared to this overall smooth out 200 SMA here. And that's because it's only going by 9 days, a 9-day period. And this is going by a 200-day period. So that is why they like to use that 200 SMA, because you get more of a smooth out price. You're not getting whipsawed. So if you are getting in this 9-day EMA here, say you're going to buy here, well, then you all of a sudden you have to sell here. So if that's what you're playing moving averages. Okay, I'm going to buy when it's above, and then I'm going to sell when it's below. Okay, so you're going to buy here, then you're going to sell here. You're going to buy here, then you're going to sell. Whereas if you're looking at the 200 SMA, you're buying right here, and then you're holding, you're taking some profits off, you're scaling back, and then you're finally selling here. And then you're not getting in again until all the way in March, and then you're buying again, and then you're getting up here, then you're scaling out, and then so on and so forth. So you can see how much it's more of a long-term play, right? And it's going to take a while to confirm those trends. But you can see why people play it this way and use those longer time frames. Now, what people usually play is going to be considered a golden cross, and that is going to be a 50-day um, simple moving average with a 200 SMA. So if we open up our studies here, we can add a study. We can go to our moving averages, and then we're just going to go to a simple moving average here. So simple moving average, and we're just going to edit this to say it is going to be a 50-day, rather, it's got the 9 right here. So we're going to go 50-day. We're going to click OK. And then you can see this would be considered a golden cross. So right here at 318 on the daily, you would say, hey, this is a golden cross right here. 50 has gone above that 200 SMA, so it's time to get long. But also remember that these all lag, right? So there's always lagging. So you can see that the trend already starts to get bullish here while we're already saying, hey, this is a bearish cross. So when you have that shorter time frame crossing under that longer time frame, it's going to be bearish. When you have that shorter time frame crossing above that lower or the longer time frame, it is going to be bearish. And you'll notice that it lags, right? So right here it says, hey, it's bearish, but guess what? We're already back in here before it crosses back over again here. So you can see this right here has already gone up all the way up to right around a $20 move before we actually got a golden cross in here again. So you have to keep into consideration that this does lag. So how do you fix the lag? Well, you can do something called using weighted moving averages or exponential moving averages. So we mentioned before we had this white line, that's 9-day EMA here. What an exponential moving average is that it's more weighted to the recent date. So it uses a multiplier. There's a different equation that it uses rather than just adding up this 9-day period and then dividing it by or adding up those 9 closes and then dividing it by 9. It's actually used where the multiplier gives more weight to the most recent date, that is, and then it takes the oldest data into consideration last, that is. So that is how you can kind of play this, and then you can see the trends earlier. So you can see that right here when we breached this 9-day EMA, that we already were starting to get bullish here before we even got here. So this is about a month in advance that we knew, hey, that we're going to get bullish here. But also, if you are going to play these shorter dates, you have to worry about whipsaw. So that's whipsaw just means that it's going to come back against you. So you can see here, if you did get bullish here, that guess what? Well, now it's going to be bearish here. And then again, it's going to be bearish here before we even get to that bullish golden cross here. So things to consider when we're playing moving averages. Basically, overall, what is a moving average? Take a time period, add up all those closes, divide it by that time period. That's how you're going to get your smooth moving average. How do you adjust that? Well, you can use weighted moving averages, or you can go to shorter dated moving averages and then play that accordingly. But we always like to put multiple moving averages on just to kind of see what the stock is telling us long-term trend, and then short-term trend, what we could see in here. And also exponential moving averages, more weighted towards the most recent date. That is going to carry the most weight rather than that oldest data. So it doesn't matter what time period you use on that exponential moving average, it's always going to be more weighted. So therefore, you can see price action earlier rather than later. All right, guys. So I hope that it kind of explains moving averages to you in a simple form, more or less. You can, it's always one of the great indicators to use when you're trying to determine long-term trends and things like that. But that is basically overall how moving averages work and how they are used. All right, guys, if you like this video, make sure to check us out on all of our social media. We also have a Discord service if you're interested, and you can find all of our socials in the description below.